Hi and welcome to The Pitch, brought to you by Livewire Markets. I'm Hunsley, and joining me today is KKR's Jeremiah Lane. Jeremiah, we're going to chat all things asset allocation and the way that KKR is approaching investing in 2024. And I love the phrase that you're all using this year. It's keep it simple. So first question, how do you create and maintain a simple credit allocation?
Sure. When we talk about keep it simple, what we mean is that you don't have to work as hard in today's credit environment to generate a great total return for investors as you did in the era of zero interest rate policy. If you can invest in a diversified portfolio of loans and bonds, pretty high quality, and get around a 9% total return in USD. And that's pretty attractive if you look at long-term averages of what a index of loans and bonds have delivered. For most of the last decade, they were delivering a little bit north of 4%. And so there's dramatically more return available with just vanilla investing in these asset classes.
So talk me through maybe some of the main areas where you are finding simple value in today's market.
Yeah, I think that there are maybe three areas that I would call out. The first is just including in the portfolio a diversified set of pretty high quality loans and bonds. We think of this as providing ballast. A lot of what we do in this portfolio is take concentrated high conviction positions and credits and adding in a more diversified portfolio of names that we are really confident in means that if we're wrong on the margin, if the economy is a little bit more difficult than we expect it to be, we have some really good companies that we think will continue to perform well and continue to pay us a lot of interest. That's the first area. The second area is we've been investing in CLO tranches. And specifically, we've been really interested in the BBB part of the CLO spectrum. The BBBs can withstand approximately 25% cumulative defaults on the underlying portfolio before you lose any principal in the instrument that we're investing in. And that assumes a 50% loss given default, which is significantly worse than the historical experience. So we see that as a very risk remote asset. You can have a default wave that exceeds what was experienced in the financial crisis, and you're still not going to lose any money. And we think you can do substantially better than that if you're really actively paying attention to what's going on in these names and you're actively managing them. And then the third area would really be short duration. Short duration is one of our favorite themes in the credit market. We've been doing that in our GCOF strategy really since inception. This is a focus on 24, 25, maybe today, early 26 maturities. You have a unique moment especially as a fully levered company approaches its maturity, where as a lender, you can approach them and negotiate what an extension would look like. Maybe we'd like better documentation. Maybe we would offer to extend with a substantial increase in the spread that we're earning. Maybe there are some, the company will pay us a number of points up front as a fee. That's a great way that for us to add a little bit of outperformance into our portfolio.
So I know that KKR kind of subscribes to this higher for longer rate environment. This is higher for longer thesis that's percolating in markets, especially for the US. So in that scenario, how do you approach asset allocation? How do you approach asset picking when it comes to portfolios?
What we're thinking about when we talk about higher for longer is that we are very skeptical of the market's view, which you can observe, via there are implied rate paths that are observable in the market. We're very skeptical that the Fed is going to quickly pivot to a lot of rate cuts. Because we don't think that there are going to be as many rate cuts, in turn, that makes us skeptical that rates are going to come down a bunch. That makes us skeptical that bonds are going to rally a lot. The only other way that bonds could rally a lot, it would be if there was a lot of spread compression. We don't see the case for significant spread compression. So it really goes into our thinking around the relative value between loans and bonds and the total return that we might earn between them. And it's probably what, at the asset class level, puts us more in favor of loans today.
This whole interview has been about how to keep it simple. So let me flip it a little bit for the last question. What market conditions would it take for KKR to become more complex again?
Sure. Well, I think that one of the things that we're really proud of with this strategy at this point is that we've been running it for over 15 years. The moments in time where we had to work harder were certainly the moments, some of the moments of zero interest rate policy, where there was so much suppression in the amount of rate and spread that was available in the market, that to deliver a decent total return to investor, you need to consider finding an off-the-run deal where you could earn a little bit of excess spread. You needed to enter into a club deal where maybe you wouldn't have quite as much liquidity. I think if those characteristics came back into the market, we'd have to think about going back into using some of those alternative levers, pulling some of those alternative levers in order to deliver return to investors. I just think it's very unlikely. I think that zero interest rate policy hasn't been a big success in the eyes of the Fed, and it's unlikely that they're going to rapidly re-embrace that.
All right. Well, Jeremiah, thanks for joining us and thanks for sharing those insights. And thank you for joining us for The Pitch. If you enjoyed the video, please subscribe to our YouTube channel and to both websites, Livewire Markets and Market Index. Thanks for watching.